Hey guys, so this video is the language of Forex, and I thought it's essential for anybody that's brand new, a few weeks in, or even a few months in, that do not know the way around with certain terms and expressions and phrases in the foreign exchange industry. So I've got the main ones here, and of course some I'll be adding into the next few videos, and I'll be explaining these in detail in the next few videos also. But long and short. So long is when we decide to mostly buy a pair and we hope it increases in price. And short is the opposite, when we hope the price will fall. Bullish is when we're looking at a particular market and we're hoping it goes up. So sometimes we refer to this as a bull market, when the price is actually increasing. And a bearish market is when we have a stance on the market where we think it's going to fall. Stop loss and take profit. Now, when you enter a trade, you have an option of protecting your capital, which is a stop loss. So if you entered anywhere in the market, a stop loss can go somewhere where you feel like, right, if I'm out walking the dog, I'm driving, I'm not in the markets, but this trade is the opposite, stop loss will cap your loss. So you can decide where you want to have your stop loss. Then take profit is on the other side, where you're aiming for the price to go. This is where you're going to get your rewards. And the same thing, you can place your target into the MetaTrader app, which I'll be explaining to you very soon, and you can actually walk away and you've got your entry, you've got if everything goes wrong, and you've got if the trade goes right. And you walk away, stop loss and take profit, essential. A lot of people try and trade without a stop loss, and that's unfortunate when they come back and their loss is a lot higher than they actually initially anticipated. Slippage. So slippage is when, now this term is going to be used by your brokers most likely, but I'll get to that in a minute. So slippage is when the price is actually moving so fast. So what we see in front of the markets, whether you're using TradingView or any of our own platforms, maybe our own platform, which we're going to have very soon, slippage is when we're actually trying to follow the price. So for example, there's a chance where the price has created a massive wick and hop back up, and most likely got stopped out, but you can't see that the price actually hit your stop loss. Slippage is when the price moved that fast, it's not recorded on the charts. So you're going to maybe see this term used sometimes. Technical versus fundamental, essential. So technical is our approach to the market. So technical is when we look at the markets and we see major round numbers, key levels, when we're applying all of our bias on the charts, whether we're drawing trend lines, Fibonacci, anything of that sort is our technical analysis. So myself and Sean and this whole course is around about 80 to 85% technical. Fundamentals is news events, so interest rates, central bank announcements, things regarding anything to do with the news, basically, to keep it really, really simple. So this we cannot predict. However, there is economic calendars out there, like Forex Factory, and you can even go on Everything FX and a few of the websites. So we have an actual page where we can actually see what news events are going to come out for this day. So it might be durable goods, it might be a number of things. So we can't predict the fundamentals, but sometimes there is a certain formula if you follow, and especially sometimes there's days where we do not want to trade because there's too many fundamentals coming out that day. So we stick to our technical analysis. Pips. So this is basically, you can use the same word as points in the market, which is referred to in the stock market, but pips means percentage in points. Dead simple. For example, 1.3, so the pip is this last digit here. So of course, this is an increase in 51 pips. Now, lucky for us, TradingView and many of the tools out there in our own platform will actually allow you to actually grab a tool and measure how many pips something is going up or down. But this is a nice, easy explanation, and I'll talk about this in a later video. But that is pips. Leverage. So your leverage is given to you by the broker, and you can choose whatever leverage you want to have. So people can even give you 1 to 1,000. Sometimes people leverage will be 1 to 5. What does this mean? Well, leverage, to be honest with you, is kind of on your side. Now, leverage, what that stops you from doing is placing too many trades with high volume. For example, if I'm placing, let's say we have a £5,000 account, and I'm placing £20 per point, which is a reasonable size. Well, a low leverage account will allow me to do one trade for £20 per point pip, another trade for £20 per pip, but then no more after that. Where one with high leverage will let me continue to place these trades at £20 a pip each. Now, where this goes wrong is you have so much on the market that the market moving 10, 15 pips in either direction can blow your account, or it can quadruple your account. Now, I recommend that leverage, you can kind of have reasonably whatever you want, but it's all down to your percentage per risk, which I recommend you do 1 to 3 to maybe 4% per trade at most. RR, your risk to reward. Now, this is what traders actually struggle the most with. So, risk to reward, how much am I risking for how much am I gaining? Am I trying to risk my 50 pips to try and gain 100 pips? 1 to 2 risk to reward ratio. 50 pip risk, 150 pip gain. 1 to 3 risk to reward. Now, what do we want our risk to reward to be? Well, of course, we don't want it to be lower than 1 to 1, but I would recommend anywhere between 1 to 2, 1 to 3. Now, if you can actually stay in the trades to let your risk to reward play out, sometimes you only got to win half of your trades. And with some good risk to reward ratio, you'll always be in profit. But no matter what you look at, always look at a trade and think, okay, what am I risking for what am I gaining? ROI, your return on investments. So this term is used, of course, all over the finance world. The amount of money you're going to put into your Forex account, what is your return on your investment? How much have you made the past week, month, year, however long you have the account? What's your return on your investment? And of course, that is something which you can analyze and potentially, I said, take your trading career as far as you want to take it. So return on your investment. Majors versus minors. So again, I'll explain this in another video, which will be a lot easier to understand. But majors, this is most likely the pairs that have all the USD in them. USD is the world's default currency. So your majors are GBP USD, Euro USD, USD Swiss, Aussie dollar, USD CAD, USD JPY. And then some of your minors are some of the less traded pairs. For example, USD NZD, Australian dollar CAD, and the list goes on and on and on. Now the difference usually is the majors are the most traded currency pairs. For example, Euro USD, that's one of the major, most traded currency pairs. So that has a lot of volume run through it, and therefore sometimes your spread, which is your cost to enter that trade, is actually lower on the majors because there's a lot of people buying and selling. Whereas some of the minors, your spread could be a lot higher. And again, I'll explain spread in a future video. Candlesticks. So candlesticks is when we go into the charts and each one of the things that we see up and down is a candlestick. We can see them in a line chart, we can see them in various different formats, but we see candlesticks. Candlesticks can represent 1 month, 1 day, 1 minute. It's up to you what time frame you want to use, but candlesticks are how we see the price moving up and down. Brokers. Now, all of you guys need a broker. I need a broker. Everybody needs a broker, especially retail traders trying to enter the markets. You are here, the broker is here, and here's your access to the market. So when choosing a broker, of course, we recommend a few, and throughout this whole program, especially Astro Accelerated, you're going to see that we have a program of our own, which you can actually kind of trade alongside of us, and we have our own broker. But for you guys out there that want to choose any broker, I recommend choosing a high broker that is really well known, and of course, you check that the spreads are low, withdrawal times, but you have to use a broker, so make sure you use a good one with a very reputable name. Indicators. So a lot of people can say, I've got the best indicator in the world and this is a Forex indicator, or I build indicators. Indicators are lagging, which means that you can place them on the charts and there'll be loads of different things that are going to help us figure out whether these things are up or down. You'll have arrows that appear, things will change in different colors. You're going to have things that will help you get in and out of trades. But in the end, all indicators are unfortunately lagging, which means they're behind the price. So you've got moving averages and you've got so many different indicators which you can use, Bollinger Bands, clouds, everything. My personal opinion, keep it simple. But indicators are there if you want to use them. Margin call. Now I left this one for last. Margin call is unfortunately where you are going to be stopped out of your trading account. So a lot of people will say, I've got margin called, or are close to margin. What this basically means is that you've got so much on risk at your account that if the trades or whatever you got on goes against you any further, you're most likely stopped out of your trade so you do not go into minus. That's margin call. Now these are the most popular terms, and if you understand them, which I'm guessing most of you will do within a few days, then be ready for the markets.